All right, welcome everyone to another monthly webinar. I'm very excited for the discussion today. As you can see per the screen, we're going to be discussing smarter giving or charitable giving strategies. So these would be ways to kind of give wealth smarter, but also to maximize tax benefits as a result of making charitable gifts. I am joined today. I'm very fortunate to have Glenn Garbett, who is a charitable planning consultant with Fidelity. Glenn and his team have worked very closely with Ausperity. They work with CPAs and also attorneys on giving strategies and tax reduction strategies. So Glenn, just first of all, thank you for taking some time and joining us for the discussion today.
Oh, it's my pleasure, Rory. It's great to be here. Appreciate everyone logging in to check out this presentation. It is kind of that time of year we call giving season. So we tend to get very busy in the last quarter of the year here at Fidelity Charitable.
Yeah, absolutely. And just to share a couple of things, like all of our webinars, please feel free to use at the top of your screen the chat feature or even the Q&A feature. I will be monitoring that. I love taking questions on the fly. So Glenn, I'll interrupt you if we have a question from any of the viewers. I've also let clients know that they could shoot me an email. I'll try to monitor that as well, just so if there are questions, whether it's clarification or anything of a relevant nature, I'm happy to present that to the discussion today and move forward. But the reason we want to have this is, yes, it's year end. How to reduce your income taxes? One way is giving and giving charitably. And Fidelity has really been setting, I think, the industry standard on charitable giving. It's something that when we started Ausperity 4 years ago and chose Fidelity to be our only custodian as of present time, was really appealing to us. Just in terms of numbers I have here, Fidelity Charitable has the largest donor advised fund in the country. And they also would be, considered the largest charity in terms of contributions, but then also the grants made. Before I make one other point, Glenn, could you just describe that? So Fidelity Charitable in and of itself, does that classify as a charity in that sentence there?
Yes, Rory. So we are a 501c3, Fidelity Charitable. We were created in 1991, so we've been in existence for almost 35 years and have just grown tremendously since then, to the point where now we are the largest charity in the country based on contributions in and grants out. And I just think it speaks to the popularity of donor advised funds in general. Mm-hmm. But I appreciate your comments. We like to think that we set the standard in the donor advised fund space.
Yeah,
let's talk a little bit more about what that means.
Exactly. We're going to really break into what is a donor advised fund, and that, again, you're going to give money to Fidelity Charitable, but from there, it just makes it a lot easier for you to disperse it to the charities that are important to you and to your family. The other important part is, or point, 300,000 Americans are using Fidelity Charitable, and my family is one of them. So I'm using a donor advised fund. I do it more so for organization and goal setting in terms of how much my wife and I want to give to various charities over the course of the year. So we're one of that 300,000. So this is not new. It's probably the industry standard and leader, and I'm excited to have this discussion today. So with that, Glenn, I'll kick it over to you as we work our way through this. Again, this deck is going to be sent to clients afterwards as a follow-up, and we are recording this video and we'll be putting it on the YouTube channel. But with that, Glenn, take us away, and I look forward to this discussion.
Thank you, Rory. Me too. So let me just give an overview of the agenda. I mentioned we will get into donor advised funds and how they work and a little bit about Fidelity Charitable, but in the beginning here, we'll talk about the charitable landscape, and that includes other options besides just donor advised funds. We'll talk about the best assets to give to fund and fuel your philanthropy. And then, since we are towards the end of the year, I want to give you some things to think about, as you sit down with Rory or you sit down with your CPA and you're kind of planning for year end as well as 2026. there are certain things that you might want to take into consideration when it comes to philanthropy. We did hit on some things about Fidelity Charitable. Rory mentioned we have over 300,000 donors at Fidelity Charitable. What we are really proud of here is that we've granted out close to $73 billion to charitable organizations over the years. We'll talk about what that looks like at the donor level, because we are a mission-driven organization. So we exist to meet our mission, which is to make it easier for Americans to reach their philanthropic goals. So the idea behind this donor advised fund, I mentioned we started in 1991. It's meant to be an easier way to fund your philanthropy and get more money ultimately to charity. And the way people do that is they create an account, they log into their account, and then they make grants out the door to their favorite charity. That's essentially what it is, but we're going to get into a little more detail here later. We're also proud that we are the largest grant maker in the United States. You know, when it comes to philanthropy and when people talk about philanthropy in the United States, I think there's this misconception that, you know, it's the big corporations that are funding philanthropy and the big foundations you hear about, you know, the Ford Foundation and the Pew Foundation, the Tiger Woods Foundation. And the reality is it's individuals like you that are attending this webinar today that are fueling philanthropy and have been doing so for decades through all sorts of economic climates, different presidents, stock market crashes. If you look at this chart, it does exactly what we like charts to do, which is go up somewhat steadily to the right.
Yeah.
And individuals fuel about 2/3 of philanthropy in this country. They obviously make quite an impact. The essence of what we do here, I think, is to appeal to the individual to make sure they give the right asset and make their granting easier. I don't think we address this in a slide coming up here, but one of the neat things about our donor advised fund is, you know, you can log into this account just like an online bank account. And you could look up various charities. You can make grants out to those various charities. And we even have an app that helps you do it so easily.
Glenn, I can speak to that, just having used it the last 2 years, and the feedback that we get from clients is like, wow, not only is it easy, it's really cool, where you can look up various charities and then just with the click of a button, distribute funds directly to the charity. The interesting thing that's also really helpful is at the end of the year, you have one consolidated tax form that you'll use to show your total charitable gift and the deduction that comes from that. But it's kind of fun. My wife and I enjoy kind of sitting down together and kind of reviewing, you know, the assets that we've contributed. And our goal is to deplete our donor advised fund every year and distribute those gifts. And there's some obscure charities that are part of that. You know, there's different chapters for universities. So it's really wild in terms of how much they pick up, but it's fun to do. It's easy to navigate. And when you sign into Fidelity to view your assets that Ausperity is managing, you know, with you, you'll also see at the bottom Fidelity Charitable, and that would be the donor advised fund if you have it set up.
Terrific, Rory. Appreciate that. Yeah, the app is you know, I'm obviously a donor myself, and the app just makes it so easy. You pull up your app. I've got Face ID. I log right into my account. I look up the Marlton Animal Shelter. It populates. I type in I hit make a grant, type in $50, and it's off. It makes giving really simple. So some of the reasons why people give to philanthropy, I'm sure many of you here can attest to some of these things and what's important to you and how you feel when you are supporting causes. Passing on values to family members, that can be a big one with a donor advised fund, because a donor advised fund has successors to it. So if we're looking at a typical scenario, it might be a husband and wife have their own donor advised fund. They are joint donors like Rory and his wife. And they might have 2 kids. They name their kids as successors on the donor advised fund. So hopefully, 100 years from now, as Rory, 100 years from now, Rory and his wife are no longer with us. Their kids will take over the donor advised fund at that time. So they are successors, and they can name their own kids to be successors. And this can go on in perpetuity. So it's a really neat thing to be able to get the kids involved in that way. Keeping engaged on the issues that are important, supporting giving goals, sometimes utilizing products that will kick off an income stream. Donor advised funds will not do that. We are going to look at other products that will. And then lastly, a major one, especially when we're looking at this time of year and assets that you can give, it's kind of the tax ramifications of making these gifts. They can be very powerful and augment some of those other reasons that we just addressed. So back to the donor advised fund, conceptually, the way if you're not familiar with a donor advised fund, I want to make it easy for you to kind of understand how a donor advised fund works. So we like to call it the 3 Gs. And these are the G's that you need to know to understand how a donor advised fund works. So the first G is give. I mentioned we are a 501c3 at Fidelity Charitable, as are many of the other donor advised funds in the country. You give to that donor advised fund. It's a tax deductible contribution, again, because we're a 501c3. And theoretically, it's the same as if you made that gift to a charity that you love, a church, a school, a synagogue, a hospital, your alma mater. These are all charities that you would receive a tax deduction for. Same thing with the donor advised fund. I like to just use round numbers to make it easy. $100,000 is a lot of money, but let's just say you put $100,000 in the donor advised fund. Your tax deduction would be based on that $100,000 gift or whatever you put in the donor advised fund in that calendar year. So if you put that $100,000 in 2025, you're receiving a tax deduction for that calendar year. The nice thing about the donor advised fund is, as that $100,000 sits in the account waiting to be granted out, those contributions can be invested. So there are a couple of ways they can be invested. If it's an amount less than $100,000, you would be limited to our investment pools, which look, if you have a 401k, they might look like your 401k investment choices. If it's over $100,000, it's great because Rory and his firm can invest Rory can manage the assets and put together a custom investment portfolio. So you're not just limited to our investment pools. So we love it when the advisor is able to give professional money management as opposed to just our pools. But they're both great. And then the last G is grant. So give, grow, grant. And this is the part we love to talk about. This is when you can make grants out the door to the causes and the charities that you feel strongly about. So I mentioned the example of logging on like you're using an online bank account, whether that's a PC or whether that's through the app. You would be able to look up the charities that you care about. And this is once you have an account. Look up that charity, select make a grant, type in the amount that you want to give. And we have to do our due diligence. We have to make sure it's a legitimate charity. They're in good standing with the IRS. But the idea is, within a day, sometimes 2 weeks if we have to do our due diligence, but somewhere in between there, that charity is going to receive a check or wire from your donor advised fund to Fidelity Charitable.
Yeah, Glenn, just to jump in there,
Charitable.
And I appreciate the examples. I mean, I learn with examples and stories as well. Here's a nice scenario. So Vanguard Growth is an ETF that invests primarily in growth funds. It's been in our portfolios for a long time. It's received a tremendous amount of growth. Here's just an example. Several years ago, you invest $60,000 in the Vanguard Growth ETF. It's now worth $100,000. So you then give those shares to the donor advised fund. Even though you paid $60,000 for that position, it's grown to $100,000. When you contribute that to the donor advised fund, you're going to get a $100,000 deduction on that gift. Then, let's say you do that in January of this year. That gets moved into a pool. That's 80% stocks, 20% bonds, so it's diversified. That then grows from $100,000 to $115,000. Now you have $115,000 that you can disperse to 1 or 100 different charities this year, in future years, etc. So your money's still working for you. It's still growing. It just means you can give more to the charity. You're getting that donation. You're getting that tax deduction for that $100,000, even if you don't distribute all of the funds this calendar year. If you had taken that $100,000 and sold those shares, you would be paying capital gain taxes anywhere from 15 to 23, 24%. And then you're giving cash. I think far too many investors and high net worth investors are making charitable gifts with cash. Here is a way where you use your appreciated investments. You don't pay a capital gain. You move the shares into a donor advised fund. You get a full tax deduction. You then can diversify the asset, and then you distribute as you please. It's really pretty amazing. And this would be a year where that's worked extremely well, where you could have used appreciated money, put it in the donor advised fund earlier in the year. It's grown. And now the benefit is actually the benefit for charities. They're able to get more assets from you, and you can set reoccurring. So from a church perspective, I do a reoccurring gift on a weekly basis. Super easy to set up. It's a couple clicks, and then it's distributed to the church that we belong. So really neat, but just wanted to share that example to kind of help break it down.
Love it, Rory. Thank you. So before we carry on, just to kind of summarize this slide, the Give, Grow, Grant. Conceptually, I want you to think of a donor advised fund. Many of you probably have either 401ks or 403bs. Maybe you have created or have contributed to 529 plans for college. What a 529 plan is to college saving, or a 401k is to retirement, you could think of a donor advised fund is that to charity or philanthropy. So we have 350,000 donors at Fidelity Charitable, something around that, $350,000 accounts. But when you give that money to Fidelity Charitable, it's a sub account. Just like your 401k, you might work at a company with 5,000 employees. Your 401k is one of 5,000 sub accounts at the 401k. You're in control over how it's invested. You're in control over kind of when you take it out. At the donor advised fund level, you're in control of what you invest in, how you invest, what you grant out to, when, how much, all of those things. So conceptually, I just wanted to draw that analogy to 401ks or 529s. As I mentioned, you could name your donor advised fund whatever you want. So the Rory giving account, and you could give out to that charity. They'll receive a gift from the Rory giving account at Fidelity Charitable. It'll either be a wire and you'll be on a spreadsheet, or it'll be a letter and a check attached to it.
Yep. Glenn, we're getting some great questions. So quick question is, how does this work with required minimum distributions?
So that's a great one. And it comes up all the time. And I still get questions almost daily from attorneys and CPAs. So donor advised funds are excluded from that provision, that the QCD provision or RMD provision, where you can grant directly your RMD to charities. Washington, D.C. basically carved out donor advised funds. They want them to go directly to the end charity. So I do think it's a great thing. If you don't need your RMD or you don't want to touch your RMD, you are able to give it directly to charity. You just wouldn't want to give it directly to a donor advised fund.
So good question. So QCDs are qualified charitable distributions. You have to be over age 70 and a half, and it's where you can use the forced withdrawal from your IRAs to go directly from you to the charity. So you're going to have to go right to the charity there. You can't fund a donor advised fund with the RMD. If you did, it'd be a taxable event. So you want to just go directly to the charity. As you know, Monica runs the majority of that for our clients. Certainly feel free to reach out to us. We can help get that set up. And we do a lot of that for our clients that are over 70 and a half. So really good question. Glenn, if you want to move on to the next slide, there's another question I'm going to be up for you here. So that the next one is, and you might even have a slide for this, but it is speaking to how can someone use the standard deduction 1 year and then itemize charitable deductions using a donor advised fund other years? That's almost like a plant question. That's a softball. How can someone use the standard deduction 1 year, but then itemize and use charitable deductions in another? So maybe that refers to bundling. And I think you have a slide for that, Glenn, if you want to pop ahead, or we can touch on that as we go.
Yeah, you know what? We will get to that in a few slides.
Okay.
It is a great question, and I would suspect you of planting, Rory, but I trust you.
I don't. Yeah, I just have intelligent clients.
That's
yeah,
right.
I just want to make sure we're moving pretty good because we're 25 minutes in here. But yeah, I know that's on one of your future slides.
We will get there very shortly, I promise. So one of the critical things, though, because I don't want to skip this, because to me, it's one of the most important takeaways for this audience, which is when it comes to funding your philanthropy, make sure you're choosing the right asset. I spend so much of my time, I've been at Fidelity Charitable for 15 years, convincing people not to write checks to charity. Cash is great. Charities love to receive cash, check, whatever, but it's usually not the best asset for you, the donor, to give. Why is that? Because it's far more powerful to give an appreciated security of any kind to charity wherever possible. So one of the things that makes donor advised funds really appealing is, I'm just going to use an example of, let's just say you were super smart and you bought Apple stock 10 years ago and it's tripled in value, maybe quadrupled in value. You put $10,000 into Apple stock back then. It's now worth $40,000. If you wanted to give $40,000 to charity, your options are to write a check for $40,000, to give that stock $40,000 directly to the charity, or to sell the stock and fund philanthropy with the difference. So before we get to that bunching slide, Rory, I've got another slide that I want to show. So if I give the cash, it's wonderful. I'll take the deduction on that $40,000 and it's good. What is very good is giving the appreciated stock directly to charity. Why is that? Because I mentioned you bought the stock for $10,000. It's now worth $40,000. So it's got the same value to the charity as your $40,000 check does. But there's $30,000 of gain there,
right,
in that Apple stock that you're going to avoid if you give that stock in kind to the charity. So far more powerful for you, because you'll get the same $40,000 charitable deduction, but you're missing out on $30,000 of capital gains. So you could do the math on 20% capital gains rate on $30,000, exactly what that means. So that's just one example of an asset that's appreciated. One of the nice things about a donor advised fund is not every charity is equipped to handle appreciated stock. There's certainly not, many of them are not equipped to take in more complicated appreciated securities. We would call them complex assets or non-publicly traded assets. I don't know how many in this audience this might apply to, but we have a group here at Fidelity Charitable that specializes in taking things that are non-publicly traded. So if you have a business and it's a partnership or an LLC or a C Corp, S Corp, we have our own attorneys on staff that are accustomed to taking in shares of private stock, for instance. Restricted stock is one that comes up a lot. Not all that easy to contribute restricted stock to a charity, but we have expertise in that. Cryptocurrency is another one. Cryptocurrency has been taking off. So these are all assets. We have publicly traded appreciated securities. We have privately held, non-publicly traded assets that we can accept, assets of all kinds. I want to give you the example of kind of like the Apple stock I talked about, but this is so to help you visualize it. This looks at the example of selling that stock to fund your philanthropy versus giving it directly. And I mentioned, picture the local animal shelter. They take in, $10,000 a year. Are they equipped to take that Apple stock directly? Do they have someone on staff?
Yeah, good point.
Who can handle that expertly? And that's one of the big benefits of the donor advised fund is you can use Fidelity Charitable to essentially take in that gift. And then now that money, the proceeds of that sale, in this case, $50,000 is sitting in your donor advised fund. And you could simply grant out from that cash, that $50,000 in cash. The animal shelter doesn't have to worry about the stock. But let's just say you wanted to accommodate the animal shelter. You're going to sell this stock that's valued at $50,000. There's $30,000 of capital gains on that stock. You're going to pay $7,140 in capital gains tax. And the net proceeds of that sale are going to be $42,860. So your income tax deduction is going to be $15,858. Now let's look at the scenario of donating the 50,000 in shares directly to charity. Your net charitable donation is $50,000. Your income tax deduction is $18,500, and the charity got an extra $7,000. The government did not.
Yeah, Glenn, in this, you're almost adding a third party that's receiving, and that's the government in the form of the tax, where you can eliminate the tax, you can eliminate the government receiving the cap gain tax by moving it directly to a donor advised fund or gifting the shares directly to a charity. Another great question in terms of what can be received by a donor advised fund, specifically with Fidelity, can you contribute foreign stock to a donor advised fund and benefit from that tax advantage?
Often you can, if it's publicly traded, like on FTSE is the UK stock exchange. Yeah, if Fidelity can take it, if our contributions people can take it, it's worth exploring.
So then I would say, feel free to shoot me an email offline, and I can just, run that directly to you, Glenn, and we can get back to the attendee here with that answer.
Yep.
Super cool.
It is certainly possible.
Sure.
Guess what? We're going to get into your bunching question that came up a minute ago, as promised. So I'm just going to skip through all these high-tech slides where you click 15 things to get to the heart of the matter. So the concept of bunching, by the way, this is really a 2025 slide with the one big beautiful bill, OBBA for short. This is changing in 2026, but I just want this as kind of a visualization of how this works. So the concept of bunching, you all probably know you have a standard deduction limitation that this year is $25,900, and essentially 10K of that is charitable donation, 6K mortgage interest, 10K SALT deduction based on this example. And unless you exceed the standard deduction limitation, you're really not getting a charitable deduction in the current calendar year. So the idea is doing some forward giving in the current calendar year so that you can exceed the standard deduction limitation. And this is what that example would look like here. So if you did 3 years worth of forward giving, $30,000 instead of $10,000, you'd be over the standard deduction limitation by $20,100. So you'd be able to apply that $20,000 directly as a charitable contribution in the current calendar year, receive a tax deduction for it, and ultimately leading, based on all the scenario that we're using here, which is in that little fine print, the tax, I think the tax rate is like either 35 or 37%. I can't even read it.
35%. And this is something we've counseled clients on that are in their final year of work, where their income bracket's going to be the highest that it will probably ever be. So they're going to benefit the most from reducing income in the form of a charitable gift, to look at the next 3 years or 5 years. And if they have the assets to do so, to make a 3 to 5 years worth of charitable gift that year, where their income's the highest and they can benefit from the most tax savings. They then, over the next 3 to 5 years, can deplete the donor advised fund, all while still taking the standard deduction. It's an amazing strategy, which is why I think that was a great question to kind of tee up that concept. If you have a large income event, perhaps you get a large bonus, there's a business sale, there's a deferred comp payment, whatever that might be, think about what year a charitable contribution is going to be the most advantageous. And if that's a one-off event, in future years might normalize, or you might have lower brackets in future years, consider this bundling strategy and approach to maximize the tax reduction and the income tax reduction. So yeah, great question. Love this slide. Perfect.
Rory, it's nonstop great questions from your team here. That's great. Really appreciate it. So we will keep this moving here. And Rory, it is 12:38, so 5-7 more minutes.
Sound good? I think that'd be, as long as we continue to take questions like this along the way, I'm perfectly fine.
For sure.
I don't want to go an hour, but I'd love to look at a 12:50 wrap up. So I think we got 12 minutes to finish strong here.
Beautiful. Okay. So let's get into the heart of one of the things I talked about earlier, which is complex assets. So I mentioned some of the assets that we can accept: restricted stock, cryptocurrency, privately held business interests, private equity, real estate even. We don't take real estate directly anymore, but we will if it's in a corporate wrapper. So we have a lot of clients who are real estate developers, and they're building, let's say, a strip mall, and they're in a partnership, and they're getting ready to sell the strip mall, and they'll make a gift ahead of the sale of partnership interests to Fidelity Charitable, and then Fidelity Charitable is made whole. So their account at Fidelity Charitable is made whole when the sale of the partnership actually comes to fruition. So a couple important things to remember with these sorts of gifts is you want to make these gifts ahead of a completed sale. Mm-hmm. So the IRS doesn't want you to make this gift after you already have a signed contract on your business. So let's say I have a plumbing supply business. I'm going to sell it for $25 million. I'm in negotiation with several different people. I strike a deal with one of them, signed contract. No one can walk away. It's closing in 3 weeks. The IRS doesn't want you to make that gift after that completed sale happens. There has to be some uncertainty for the donor to receive their full deduction. So people make these gifts when they're undergoing, they're fielding bids, or they're in a negotiation stage. A couple of other quick things. This is really just to get your wheels turning. If you have a business or you're an entrepreneur, you have assets that look like these, like cryptocurrency. These can be the best asset to give to charity. So that example, I'll go back to the example of I've got a plumbing supply business. It's worth $25 million. I want to give 10% of the proceeds of the sale to charity. I am far better off donating the $2.5 million of interest in my $25 million business, my plumbing supply business, ahead of the sale,
Mm-hmm.
Now I've given $2.5 million to Fidelity Charitable. Why is that? Because I'm going to pay capital gains tax to $22.5 million instead of $25 million, and I'm going to get a $2.5 million charitable deduction in the current calendar year when this deal takes place. It's a home run for a donor when you have assets that look like this. So if you do have assets that look like these, really great to have a conversation with Rory and see if it has legs, and he'll bring me in if need be.
Even if it's less than a $25 million business, that works too. The numbers don't have to be multi-million to have an impact on your own personal tax return.
100%. I'm glad you said that. I just like to pull out round numbers, Rory. So sometimes I throw out 100,000 or 25 million. They're just examples. The smallest I have taken in this space was a share of, it was a kidney dialysis clinic, and it was like $35,000 or $40,000. But I would say the interest that you contribute to a Fidelity Charitable, you're going to want it to be six figures or more, generally speaking, because there's 100 different reasons why this can be great for the donor. But there's one rub, and that is the donor has to get their own valuation of the business. And that's an out-of-pocket expense. I've seen it cost $1,000. I've seen it cost $8,000. Probably not worth it on a $50,000 gift, to pay $3,000 for a valuation. It's just not, there's no incentive there. So, all right. So let's keep it rolling here. I mentioned at the beginning that there are other charitable vehicles that people could consider, particularly if they were looking for income. And generally speaking, here's a snapshot of 4 of the more popular charitable vehicles in the country. We've discussed the Donor Advised Fund. You're probably very familiar with family foundations, or at least you've heard the term before. Private foundations, family foundations, they could be called. Generally speaking, when I started in 2010 with Fidelity Charitable, people talked about, I would speak with the state attorneys, and they would say, hey, unless you have $1 million, $3 million, it's really not worth creating a family foundation. It's kind of like creating a business, and it's a little bit labor intensive, the administration, the cost, all those things. Now, I would say I commonly hear attorneys talk about like 10 million or more. That's the point where people might consider a foundation. But in many ways, we are, at least in theory, the competitor to a family foundation or another vehicle they could do a side by side on. Look, it's not one size fits all. Family foundations can be great for the right family. But just to give you an example of where it's not great. So we talked about privately held assets, non-cash assets, a donor advised fund, the tax deduction if those private assets are given to a donor advised fund. It's a fair market value cost tax deduction. If it's given to a private foundation, it's based on cost basis. So if I created that plumbing supply business for $10,000 back in 1995, that's my tax deduction, $10,000 if I give it to a private foundation. If I give it to a donor advised fund and I sold it for $25 million, that's my tax deduction is based on that, the fair market value. So other vehicles. So Rory, does it make sense to go over private foundations more, or should I keep going?
No, I think we should move on. The charitable lead remainder trust is, a way of you receiving income, and then the proceeds transition to charity. That's part of an estate planning discussion and plan and strategy. And I think we already touched on giving a check or cash, which is great, and it's the easy way, but it's likely not the most tax beneficial for you as the end client. So I think we're good to move to the next slide as we try to wrap in the next 5 minutes or so.
Yeah, that's great. So we have
a good one. So this is the visual of the website that you can see here, which is great. You can see not only the account up in the top left corner, you can see your year-to-date contributions that you put into the donor advised fund, the grants, which is how much you've distributed to charity. And it's just those blue buttons there to put more money into the donor advised fund. You click that, it's automatically going to pull up your Fidelity accounts. You can pick the security, the shares, the lots that you want to transfer over. It's phenomenal. And then make a grant is as simple as clicking that button that's also in blue next to it, where any charity you've given to in the future, in the past, is pre-populated. So you don't even need to search for the charity anymore. You click it, pick the dollar figure, and send it out. This really is a big wow for clients in terms of how easy it is and kind of how it's nice to navigate. It's something that some of our clients are starting to bring their family members into some of the discussion or even some of the decisions as well. So I think this visual is really important for everyone to see, what it looks like.
Appreciate that, Rory. Yes. So if you go to fidelitycharitable.org, again, fidelitycharitable.org, we do have a live demo, and you'd be able to pull up this example.
Yeah, that's a great note. I'm going to make a note of that and actually put that on our follow-up to everyone attending. We'll send a link to that website.
That's great. Appreciate that. Yeah, there's so many resources on our website. This is just one of them, but this I love because number one, it gives you a flavor for what it would be like to have a donor advised fund. But also it has a live database of charities. So if you're wondering, hey, what would it look like if I opened a donor advised fund? Would my church even be in there? Would the animal shelter be in there? You could go into the database and you could see. It's not the end of the world if your charity's not in there. It just means we need to do the due diligence on it for you to be able to grant to them. But once that's done, you're able to direct grants to them. You could even set up recurring grants. So if you give $200 a month to your church or your synagogue or your alma mater, you'd be able to set those up as recurring grants. So it takes some of the heavy lifting off of you. I know in my world, it's like, if I'm not setting up a payee as regular monthly or they pull it from my account, I'm in trouble. Because that's same thing with philanthropy. You want to set up recurring grants if it's something you give to on a monthly basis. Set it and forget it. All right, so we're coming up on the end here. Last thing I will close with is the gift for giving. It's really neat at the holiday times to consider this.
Yeah, I didn't know this. You informed me of this for the first time in our discussion a couple weeks ago.
Yes. So it's a great thing to know about. So let's just pretend you set up a donor advised fund account and you want to get your kids or your grandkids involved in philanthropy. We have something called a gift for giving. So you could give this to a friend, an employee, a grandchild, a child. It's basically an e-gift certificate from your account that basically you could do it in any denomination from $50 to $5,000. The story I like to use is around the holidays. If you have your kids or your grandkids and you say, hey, we want you to pick, here's $100 gift for giving. It's going to come out of your donor advised fund, but they're going to pick the charities that they want to give to. And so maybe that's the Thanksgiving meeting. You go off for the next month. And when we get together at the end of the year for the holidays, you're going to present why you picked a certain charity. And that $100 e-gift for giving is redeemable by the charity. It will come out of your donor advised fund, assuming it's a charity that's in good standing with the IRS. So that's the basic concept. I know we're coming up on the end, so I kind of gave it the rush job, Rory, but I know you. No,
I think it's great. I mean, it's something that I learned for the first time. I plan to use in discussions with clients that do want to incorporate their children or their grandchildren, and the gift for giving is a really easy way of doing it. I just kind of brainstorm how that could be used. Hey, you have the conversation in Thanksgiving. I know I typically give you money for Christmas if this is a nephew or a niece or your children. As they get older, I can already see how it's harder to buy them gifts now, but hey, I'll give you $100 for Christmas. for yourself, but it's important that we'd like you to give $100 as well. So I'm going to give you an additional gift for giving of 100. In order to receive the 100 that you can put in your bank account, I'd like you to figure out the charity that you would give the gift for giving $100 to. I mean, that's an interesting way, as I at least want to try to teach my children about, earning money, saving money, but also gifting money. That's a really neat one, and one that I want to look into a little bit further. But no, Glenn, this is great. Also phenomenal questions as we go through this. The concept of donor advised funds can be a little bit difficult to grasp at first. It also can be confusing in terms of, okay, well, what assets? So think about it. These are really non-retirement assets. Appreciated investments are likely the best to fund the donor advised fund. If you have large retirement assets and you're over 70 and a half, I think most of the charitable giving should be coming from the qualified charitable distribution, which is directly from your IRA to charity. But the donor advised fund has been really increasing. Fidelity is the industry leader. So Glenn, it was great to have those discussions today. I appreciate everyone who continues to turn into these webinars, and we're just trying to help educate on all the various topics that are finance, investments, planning, tax. So Glenn, this was a great presentation, and I look forward to getting this video edited up on our YouTube channel, and then also sending a couple of these relevant websites as a follow-up.
That was terrific, Rory. Thank you so much for having me.
Yeah, appreciate it. Have a good rest
everyone.
of the week. Yeah, you have a great Thanksgiving as well. Thank you.
Take care.